This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 331 was recorded on July 7th, 2022. I'm Erik Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Atlas Investments chief strategist Jeff Snider returns as this week's feature interview guest. Jeff says that monetary inflation is not the cause of out-of-control consumer prices, and he doesn't see stagflation as a big risk. We'll discuss all of that and much more in this week's feature interview. Then be sure to stay tuned for our Postgame segment when Patrick's chart deck will be titled Summer Doldrums.
And I'm Patrick Ceresna. Erik, let's get to that S&P 500. You know, like we just a couple weeks ago, we were watching that S&P just getting crushed to the downside. Everything was just rolling right over. But things have really quieted down. I want to talk about it in the post game. But what's your thinking on what's happening in the equity markets here?
Well, if you say things have quieted down, it's clear that you're trading equities and not commodities, because what I find most fascinating, Patrick, is this was one hell of a week in macro. Not in equities, but I mean, commodities are crashing across the board. You've got gold way down. You've got crude oil beyond way down, now bouncing pretty dramatically back up. Dollar breakout, really, really big macro event week this week, as far as I'm concerned. Yet, as you say, the stock market's just plugging along, not doing much of anything special. So I really am having a hard time. It seems to me like the big sell-off in commodities has all been a function of the market pricing in the coming recession, which I'm convinced we're headed towards. Okay, but if that's what this is all about, why is the stock market, just doing what it's doing? Now, one of the ways that you can tell when a market has bottomed is when bad news doesn't cause it to go down anymore. And I guess you could make that argument that there was a lot of news that hit the tape on Tuesday morning with commodities down hard, dollar breakout, and it didn't really hurt stocks much. Could that mean the bottom is in? I was thinking we had much lower to go, but I don't have a good explanation of why the stock market has kind of shrugged off everything that the rest of the broader markets really got smacked in the face this week.
Well, I couldn't agree more. Like the doldrums really we'll talk about is in the equity, because one place where things really have been moving is in the currency markets. The U.S. dollar broke out. But what's interesting is that the U.S. dollar breakout this time is actually coming from the currency that is the greatest weighted in from a trade weighting perspective, and that's the euro, with a substantial breakdown to a decade low. And the dollar's on route higher. What's your take on the dollar here?
Well, this breakout is definitely very significant, and I think it's the dollar breakout that probably was the trigger that caused the panic in copper and gold and crude oil and everything else. So it's perfect timing to get Jeff Snider on the show. I don't want to steal his thunder, so I'll save his comments for the feature interview. But as far as where this is going, I think we go much higher on the dollar index. I don't think this was the final blow off top. I think this is just the beginning. Now, as far as how quickly that happens, we'll see. We had the first breakout above the 5-year resistance was kind of a dud. Maybe now we're finally getting some traction and starting to actually move higher. Let's see how it looks in the next couple of weeks. But I think the trend is going to be higher dollar.
All right, well, let's move on to crude oil, because things seemed a little quiet at the start of the week, and then we had that huge breakdown, almost $10 in a day, just an extraordinary one-day move that saw crude oil get under 100. Bouncing back pretty solid. I mean, right now we almost made it back to 105, but volatility in the oil markets is here for sure. What's going on in your mind?
Well, there's a lot to unpack here. Let's start with EIA inventory. crude oil reporting a massive build of 8.2 million barrels. That was really only 2.4 million barrels of build after you consider the 5.8 million barrels that was taken out of the Strategic Petroleum Reserve this week. But still, it's a build on inventory, and it's a really big build on inventory when you get the help from the SPR. Cushing, Oklahoma, building a de minimis 69,000 barrels, still well below 25 million barrels, just above the operational tank bottoms, which are around 20 million barrels of inventory, and Cushing is where they consider the bottom of functional inventory to be, and we're just barely kissing that number, about 1.5 million barrels above it now. Gasoline and distillates, the finished products, were the big drawdowns on the board. Gasoline drawing down 2.5 million barrels, distillates drawing down 1.3 million barrels. We still have the lowest stocks ever for this time of year, and summer has only just begun. U.S. production was unchanged at 12.1 million barrels. Now, overall, Patrick, my hypothesis for what's been going on in this market and where it's likely to go is I thought WTI was going to grind higher and higher until the market eventually processed and priced in the upcoming recession. I thought that would be at least $10 down on that event of pricing in the recession and consensus coming around to recognize what was coming. Probably more than $10, but I said a minimum of that. And then what I thought would happen is that after that big move down, just as all the macro guys are saying, okay, recession coming, that can only mean crude oil has to just trend lower from here. I thought there would be a big surprise move right back up as we get the flow effect out of the system. In other words, the people that are selling because they're pricing in a recession, once that flow is out of the system and stops pulling the prices down, I thought they would end up going right back up because this is a supply story. It's not about demand, and the demand destruction that a recession is going to bring on, I don't think is going to be enough to make a difference. So there were several signals that are telling me that perhaps that's what's playing out right now. Now, if you look at the flat price chart, Patrick, especially with that great big move that we had Tuesday morning after the 4th of July holiday, the market is pricing in a recession. It was not just crude oil. It was also copper and gold and everything else, selling off commodities across the board, selling off hard on Tuesday morning as everybody expects that recession. Well, hang on a second. That's the flat price, which is what big macro traders tend to trade. Professionals in the oil market generally trade time spreads more than the flat price. If we look at the time spreads, they tell an opposite story from what we're seeing in the flat price. Flat price is definitely really big dip here, bear market. Trend is down. Looks like it could have much further down to go if you just look at the chart. But if I look at what the time spreads are doing, when WTI peaked back on June 14th at 123.65, at that point, the prompt time spread, that's the difference in price between the first and second delivery months, between the August and September delivery contracts, that spread got all the way up to $2.93, almost $3. Now, for the sake of some historical perspective, more than 50 cents per month of backwardation is historically significant. It doesn't usually, if you look at 20 years of data, it's usually less than 50 cents of backwardation. You get to more than $1 in a single month. That's an outlier. That's a really big thing. We got to almost $3 back on June 14th when the flat price hit 123.65. Now, the last time that the flat price was below $100 was in early May. At that point, that same spread between August and September was only $1.62, about half of what it was on June 14th. So clearly, as we get the flat price way up, the spread went way up, hit almost $3. Well, now we're back down. As we're speaking now, we're over $100. But since I wrote my notes before we moved above $100 this morning, let's pretend it's still just below 100. So if we're below 100, where would you expect that August-September spread to be down to? Back to $1.62 in there somewhere? Or could it be as much as $2? Well, guess what? It's $3.80 today, earlier today. That is absolutely, it's like the macro traders are saying, prices going lower, there's a recession coming, and the physical market guys are screaming at the top of their lungs, we don't know where the hell we're going to get the oil to settle the next 3 contracts, because the upcoming August, September, and October expiries really look ugly in terms of having the physical oil necessary to settle those contracts. And that's the reason these time spreads are going to the moon. Normally, time spreads to the moon is a very bullish signal. It means that the flat price is about to go up and go up a lot. But this is happening coincident with the flat price collapsing. So I think what we're seeing here is 2 different groups of traders with different perspectives. The macro guys that are looking at recession coming are saying it's got to be bad news for crude oil. That's a self-reinforcing process. Once enough people say that, they're all selling. That selling begets more selling. You get below certain technical levels, and now technical funds start selling. Trend followers, algorithmic traders start selling, and the selling goes on and on. But if you look at what the physical market is telling us through the time spreads, it's that we have an incredible shortage of oil, and prices are probably set to rise substantially. I think that the latter, the higher prices, are going to be what prevail in the end here. The question is, how much longer? Is there another wave down in prices to a new low below $90 before the pricing in of the recession is complete and we move back higher? Or have we already seen the low, and what the physical market is telling us is about to take us back up to new highs? I'm not sure, but it's definitely very, very strongly conflicting signals. I've never before seen front of curve time spreads exploding to the upside at the same time as the flat price is crashing. That's almost impossible for that to be happening. So the physical market is screaming out bullish, and the macro traders, I think, are the only ones that are bearish here. Meanwhile, Putin is just letting the West do the work for him. He doesn't have to do anything but sit back, and it's almost like the Biden administration are Russian assets or something. What we saw this week is 5 million barrels of oil taken out of the Strategic Petroleum Reserve. It was reported was exported, including to China, thanks to Biden administration policy. So you pull a bunch of oil out of the SPR because you don't understand how the market works, and you don't understand that this is mostly about refining capacity. Because we're constrained in refining capacity, thanks to President Biden's policies, you end up not being able to use all of that crude oil that comes out of the SPR, and the market does what the market does and exports it to China. Brilliant policy, Mr. President. I couldn't be more impressed.
Erik, so let's move on to gold, because for a month, gold was just trading in a $50 range, higher, lower, quiet, doing nothing. But as we traded down towards the May low, suddenly this week we saw the break, and once we got under 1800 decisively, it really hasn't slowed down, and we're trading down around 1739 here in gold and approaching 2021 lows pretty quickly here. What's in store for gold?
Well, it was pretty easy to see this coming. We've been talking about it for weeks on MacroVoices. You and I both have been looking at this chart saying, oh boy, took out all the moving averages. Looks like it's really set to take a dump here. That's what it's doing. I would think 1680 is the next logical support level. That was a really big level that held, what was it, a year or so ago? And if that doesn't hold, I think it's down to, a 14 handle. The way that you would get there would be a stock market crash taking us there. And we haven't seen that yet. If anything, the stock market has been incredibly resilient this week, given everything else that's going on macro-wise. So, we'll see whether or not that's coming or not. But I think the risk to the gold market is if the stock market takes a dive, gold will be pulled down with it.
Well, we'll talk about it a little bit more in the post game because I have my own little theories on that as well. But let's just finish up here on the market wrap with the 10-year Treasury yield, because we worked our way down under 280 on an intraday basis, and getting a little bit of a bounce. And at the time of recording here, we're right at 3% on this yield, and that was such a key pivot in your mind before, and here we are again. Do you have any bold market calls here on the yield at this level?
Well, Patrick, at least it's back up to 3% today after having traded quite a bit lower earlier in the week. And, I think it's basically the market is telling us that it's still undecided. We eliminated the scenario of it just kissing 3% and then moving much higher. Didn't go that way. But it started to go lower, and we thought it might keep going lower. It didn't go that way either. It's back to 3%. So the 10-year yield is definitely the barometer to watch to keep your pulse on what's happening with the inflation trade. I don't have any forecast. Let's ask Jeff Snider in this week's feature interview.
Well, like you're saying, this week's feature interview guest is Eurodollar University creator Jeff Snider. Now, Erik, why do we get Jeff back on the show this week?
Well, Jeff has moved on to a new firm. He's also taking the Eurodollar University podcast to the next level with our friend Emil Kalinowski. And it's been forever and a day since we had him on the show. But particularly, the reason I wanted to get Jeff back is so many of our guests have had an inflation view. Inflation is not transitory. It's persistent. Some even say secular, including myself. Is that really the story? Well, I'm trying to find guests that have a contrasting view so that we can hear the other side of the story. Jeff Snider is one of them, so I wanted to get his views on inflation particularly and where the 10-year yield is headed from here.
Well, Erik's interview with Jeff Snider is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Jeff Snider, Chief Investment Strategist for Atlas Financial and author of the Eurodollar University. Jeff prepared a terrific slide deck to accompany this week's interview. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads just above Jeff's picture. Jeff, we've had so many guests on the program talking about secular inflation, inflation not being transitory, expecting it to be persistent, and of course that leads to all kinds of follow-on predictions from there. I've been looking for contrary views, and I knew I could count on you for one with respect to the inflation call. So let's dive into your slide deck and go through the big picture of why you see this macroeconomy a little bit differently than the inflationists that we've spoken with.
Well, Erik, it's no wonder why so many people have thought that inflation is going to be a continuing problem, because obviously it has already been a problem. Consumer prices have accelerated wildly, as everybody knows, particularly in the energy markets over the last year. But for me, it was always a question of, and we had this discussion last time I was on last year, I think, where was it actual monetary inflation? Is this really inflation, or is this a transitory supply shock? And I know people hate that word transitory because in the modern perception, at least, attention spans being what they are, you don't associate with maybe a multi-month or even multi-year period with the word transitory. But yet in macro timescales, time and again, we've seen throughout history that transitory can last a lot longer than maybe you think it is. So we start with the fundamental possibility of whether or not consumer prices were rising as being caused by excessive money printing, currency, whatever you want to call it, or through other reasons. And for me, the monetary system did not change at all in 2020 and 2021, despite the fact the Federal Reserve went nuts with quantitative easing. But the monetary system has been telling us all throughout the last couple of years that it was not inflation, that it was a transitory supply shock. And now the markets are all uniformly describing now in July of 2022 the downside of the supply shock rather than continuing secular inflation. And we can start with, on the slide deck, slide number 3, we have a diverging views being priced into several markets versus the mainstream markets, including, or that mainstream narrative, including what the Federal Reserve is projecting. You go back to what Jay Powell was talking about in the middle of June, the last time they did their rate hike press conference. Biggest rate hike since 1994, 75 basis points. The Federal Reserve is clearly committed to its it's basically a single mandate, which is it's going to be chasing CPIs with rate hikes. So the Fed said, hey, we screwed up last year. It wasn't transitory. Inflation's a bigger problem. The Fed believes, as I think most of your guests have believed, that this is more than just what it was at the start. And slide 4, obviously they're expecting that because this is a lingering problem, that rates are going to go much higher than they are now. They're going to stay higher, but maybe a little bit longer than anticipated. And that it's not going to have any real impact on the economy, at least not according to the SEP models that are projecting unemployment to go up a little bit from its very low position where it is now. GDP, according to these models, isn't supposed to be all that bad either this year or next year. No real changes there. So according to Jay Powell, the labor market's good, the economy's good. In fact, the labor market is a contributing source to what they believe is inflation pressures, and that rate hikes need to happen, and they need to happen aggressively in order to get this stuff in check. But then we go to something like the Eurodollar futures market, and it looks very, very different. It's not just slightly different or a variation from the Federal Reserve's models or the projections. It is an entirely different case, and it's been building this way since last year and has become extreme over the last couple of days. In fact, the last curve on my chart here on slide 5 is for last Friday, July 1st, and it's already changed a bunch just today. Markets are really moving in the same directions as Eurodollar futures. And I got to stay here in case Harley Bassman, if you're listening, I'm not saying that Eurodollar futures are making predictions, because I know Harley, that's a bugaboo of his, and he's absolutely right to point this out. But Eurodollar futures are a set of probabilities. And we look at the curve shape in Eurodollar futures currently, how they're deeply inverted all the way into the whites. What that says is the market is preparing for a very high probability that rate hikes don't go to the end of this year. So you have the Fed, secular inflation, rate hikes are coming for a very long period of time. They're going to be ultra aggressive. And then the market more and more and more certain. Nothing is ever completely certain, but the probabilities have gotten very high, which is why you see these really nasty distorted curves in Eurodollar futures and others, which are saying, hold up here. Something else is going on, and that something else is going to likely interrupt the Federal Reserve's rate hike schedule and plans, if not interrupt them entirely to the point where they actually have to turn around and start aggressively cutting rate hikes, because that's the dip in the inversion of the Eurodollar futures all the way through the reds into the greens now. So the markets are going in a different direction than Jay Powell and the mainstream inflation case has been. And slide 6, there's been any number of somewhat excuses or attempting to justify how we could just wave our hands and say, let's just ignore the signal that's coming from Eurodollar futures. People say, well, Eurodollar futures are nothing more than hedging, to which the reply should immediately be, well, yeah, of course, that's what they are. They're hedging instruments, but they're not just hedging instruments that you or I, Erik, are using. These are instruments that are being used to hedge trillions upon trillions of dollars of fixed income portfolios and risk positions all throughout the global economy. So if these massive players throughout the global economy feel the need to hedge in such a way that it upsets the Eurodollar curve, meaning that they're preparing for lower interest rates in the immediate future rather than where interest rates are supposed to be according to the mainstream narrative, you need to pay attention to that. And that's something that has happened repeatedly throughout history, including just a couple years ago in 2018 and 2019, when the Eurodollar futures curve had inverted in June of 2018, beginning in June of 2018, signaling the same thing. These massive players deep in the money system, deep in the fixed income system, were hedging against the possibility that the inflation, Jay Powell, aggressive recovery, all that stuff was wrong in 2018 and 2019. And eventually it would lead to lower, not higher rates, which was proven correct. Eurodollar futures had done the same in 2006 and 2007, predicting the higher probability of what became the Great Recession and global financial crisis. They had done the same thing starting in 1999 and 2000s before the dot-com bubble. You had inversion in the Eurodollar futures curve. So even though this is quote unquote just hedging, the people who are doing the hedging and what they're hedging representing is something you need to pay attention to. And the fact that it's the history of Eurodollar inversion has been repeatedly validated is another factor to consider. But many people in the mainstream have said this time it's different. So yes, maybe Eurodollar futures got 2000 right, the dot-com recession. Maybe they got 2007, 2008 right, and 2018, 2019 right. But this time it's different. The Fed isn't just going to stop raising rates. It's not going to stop its rate hike regime. It's not going to stop, Jay Powell's not going to end his press conferences saying we need to fight inflation, because this time the CPIs are different and the Fed reaction function is different, which is meant to mean that, last time in 2018 and 2019, maybe the Fed panicked a little bit because of what happened in late 2018. The stock market started to fall, some negative indications in the economy, and they didn't need to necessarily accommodate the markets, which wasn't actually the case to begin with. But either way, this time is different. The Powell, the Fed, every FOM speaker has said, we are going to set aside our unemployment mandate or max employment mandate and focus exclusively on the CPI. And so this time, the Eurodollar futures curve must be wrong, because the Fed is not going to stop raising rates because inflation is such a big problem. And that's something historically, go to slide 7, that certainly Fed officials have talked about the Eurodollar futures curve and have said, we can't take this thing literally. Again, Harley's point, we don't take it literally. It's about probabilities, and that these inversion periods, as Dudley was saying in 2007, this hedging could push implied yields on Eurodollar futures contracts lower than what would be consistent with an unbiased forecast. Well, that's the point. It's not an unbiased forecast. It's the Fed's forecast. So what we're really saying here is the Eurodollar futures market is betting against the Fed, even though the Fed in 2022 has said CPI, 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 we're going to aggressively hike rates. And so what you see on slide 8 is that the Eurodollar futures market on the left-hand side, the front end of the curve, the front end contracts have indeed priced in this one trick pony Fed reaction function, which is the Fed is going to be aggressive. Yet as that reaction function has been priced into the front end of the Eurodollar futures curve, the back end has remained resolute and constant throughout the entire period, which means that the market knows the Fed is going to be aggressive, or the Fed wants to be aggressive. And the back end of the Eurodollar futures curve is saying, too bad. We don't agree that the Fed is going to continue raising rates anyway. Yes, they want to. They think they need to, but something else is going on in the economy that these hundreds of trillions of dollars in risk positions require being hedged in this manner, which suggests that the Fed, despite its intentions, is not going to make it to the end of the year with its rate hikes. Even though CPIs right now are at 40-year highs, even though Jay Powell's as aggressive as any Fed chairman has been since 1994, all of that stuff doesn't matter. The Eurodollar futures curve is increasingly certain. It's never 100% certain, but is increasingly positive that none of that stuff matters. There's other things going on in the economy. And then we have to figure out and ask ourselves, well, what would it be? What could possibly happen over the next couple of months that would force Jay Powell to get out of his one-minded or his one-trick mind, focus on CPIs, and maybe start cutting interest rates? And that's nothing good, to be sure. And that's also nothing that's going to be inflationary. And it's not just Eurodollar futures curve, though. This is just where the divergence in opinions is most. The contrast is so sharp. Where the Fed and most mainstream narratives are inflation, 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 and here we have a market that's based on 3-month LIBOR, which is supposed to be related closely to the federal funds targeting and what the Federal Reserve does, and yet the market is increasingly certain that something is going to go wrong in the Fed's very own backyard. So if you go to slide 9 and slide 10, what you're seeing is that this isn't just about rate hikes, though. This isn't just about this year or CPIs. You can see it going back to last year. The Eurodollar futures curve began its journey toward inversion all the way back in October of last year. It first inverted back in December, long before all this reaction function nonsense, long before all this aggressive talk from the Fed. There was growing angst and uncertainty, growing need to hedge in this massive market going back to October, which not coincidentally, if you go to slide 10, you'll see the same thing in the U.S. Treasury yield curve. Now, of course, we've heard all sorts of excuses and talk about how we shouldn't pay attention to the yield curve either. The Fed buys bonds. We can't depend upon its signals. But like the Eurodollar futures curve, it's not one thing or another. It's all the things. So since the early part of October, we've seen flattening and then inversion in Eurodollar futures. We've seen flattening and now inversion, especially today in the Treasury curve. All of these markets coincidentally in corroborating fashion saying the probability that we were going to have sustained inflation from in 2022 and beyond was diminishing over time. Because remember, flattening yield curve is about growth and inflation expectations built off the short end and what the Federal Reserve is doing. So the more the Fed raised its rates and forward guidance, didn't matter to the market because the market continued to project lower and lower inflation and growth potential off of that. Why is that? So what are we really talking about here? Slide 11. What is it that's bothering the Eurodollar futures market, the U.S. Treasury market? Why is the dollar skyrocketing? Why are all of these things happening? Well, the first easy thing, I think that one factor that most of the public seems to be coming to terms with and has already come to terms with is that there's very likely to be a recession, not just in the United States, but around the rest of the world. Go to slide 12. Facebook and Mark Zuckerberg was said we're preparing for one of the worst downturns we've seen in recent history, and that they're going to lay off workers, as Tesla has already, Elon Musk has already said. Despite Jay Powell's assurances that the labor market is strong, and maybe it kind of looks strong over the last couple of months, but that's not likely to persist through the second half of the year. Again, that's what markets are proposing, that the global economy is about to undergo changes that are going to look more like recession than not. I mean, the GDP now, the projections for GDP in the second quarter of this year, we already had a contraction in the first quarter. So I'm not looking for any kind of technical recession. I think the technical recession, the 2 negative quarters of GDP, are more about confirming the fact that we're heading into a real recession, a recession. And that's really what's one of the reasons why markets are pricing the way they are. Slide 13. Very bad news for Mr. Powell, because FRBNY, the New York branch's own DSGE model, has said, yeah, we're kind of getting this recession feeling too. He might go on TV and say that the labor market's strong and the economy is otherwise healthy to withstand all the stuff that he plans on doing. But the updated projections between March 2022 and June 2022 don't conform to that analysis. In fact, the downgrade was so bad that it now put the June 22 projection midpoint where the lower bound had been in March 2022. So FRBNY's models are picking up serious downgrade and degradation in economic circumstances and potential going forward. Now, literally taking these models literally, which you don't do, what they're projecting is that real output in GDP over the next 2 years, so 2022 and 2023, are going to be lower in the fourth quarter of 23 than they were in the fourth quarter of 2021. Now, that doesn't tell us how we get to that point, but what the models are saying is that there's a high enough likelihood that between the end of 2021 and the end of 2023, something is going to happen that will cause GDP or output to shrink and then maybe not come back all the way. That could be a nasty recession in 2022. It could be a shallow, prolonged recession throughout 22 and 2023. It doesn't matter at this point, because what does matter is that the models themselves are actually picking up the material degradation in the U.S. economy and extending that globally. One of the reasons we go to slide 14, the labor market, contrary to what Jay Powell says, is really not in all that great shape to begin with. First of all, the long term, we have fewer jobs in May of 2022, which is the last payroll report we have. We'll get the June payroll report at the end of this week. But as of the data we have, there are fewer jobs in the economy in May of 2022 than there had been in February of 2020. So 2 years, supposedly red hot recovery, and there are fewer jobs. And that, of course, doesn't take into account the 5, if not more than that, 5.5, maybe 6 million of jobs that didn't happen because they never had a chance to happen. So in terms of the labor market, I know people have been convinced of this great resignation labor shortage, but the fact of the matter is we have fewer jobs. We have a bigger problem, a much larger participation problem this time than last time. And we've seen this happen before. The same thing happened after the 2008 crisis, where the job market never really did come back, even though the unemployment rate continued to fall. And economists and policymakers made all sorts of excuses about why that was, just as we're hearing over the last couple of years, how, well, the economy must be red hot because of consumer prices, yet we still have fewer jobs. So entering 2022, the labor market has never recovered, which, of course, creates the very fragile macroeconomic situation rather than a robust one, as Powell is trying to predict. So that's one thing that the Eurodollar futures market and Treasury curve are taking into account of, as is the latest labor market data. Not only do we see in the ISM numbers where their employment metrics are falling below 50, in the household survey that actually shrank for the first time since 2020 in the April data, and then didn't recover all the way in the May data. So we have the first 2 months decline in the household survey, which indicates, because it's 2 months, the household survey is very noisy month to month, because it lasted for 2 months, that indicates a very high likelihood that maybe there's something going on in the labor market already, which then gets back to what the curves are all pricing. And we can just continue going through macroeconomic data. If you go to slide 15, I think a lot of people are aware of consumer confidence, the University of Michigan survey at a record low, lower than 2020, lower than 2008 and 2009. The IBD TIP economic survey, their index, lowest since 2011. 2011 was not a good time to be compared with. So consumers already in the dumps. We've got questions about the labor market. We got cryptocurrencies crashing, which is, if this was a secular inflation period, why isn't the what's supposed to be the primary way to protect yourself against inflation? Why is cryptocurrency crashing when it should be shining? This should be the digital currency's moment to shine. Yet something else is going on, and look at where it changed. It goes back to October of last year, same as Eurodollar futures, same as the U.S. Treasury yield curve flattening. We're getting a consistent signal that goes all the way back into last year that tells us something's going wrong. If you go to slide 16, this is not just a U.S. problem, it's a global problem. You see it in the rising U.S. dollar too, which is, today it's spiking again, which is nothing good. The U.S. dollar is a global bellwether about global financial and monetary conditions, which, again, going back to my first point, if the monetary system there's no excess currency, there's no money printing going on, in fact, the monetary system is contracting, you're not going to end up with sustained inflation. You're not going to end up with inflation for very long at all. Eventually, it's going to come with all the nasty consequences, with the downside of a supply shock as well as contraction of money, which again ties back into what these curves are all saying us, which is something's really starting to go wrong. And it's really started to go wrong since around March of this year. And it's not just in the United States. It's not just the U.S. labor market. There's all sorts of contraction indications, recession risk rising across Europe. If you go to slide 17.
Hang on a second, Jeff. Let me interrupt you here, because I want to just push back on the whole thesis of what you're saying, which is Eurodollar inversion is telling us, something changed. Now, if I go back to the other thesis that our inflationists have shared with us, most of them are talking about stagflation, and the expectation has been that after the COVID crisis, the stage was set for a new period of secular inflation, but the economy is going to be clobbered as a result of the Fed pulling back stimulus. So we're going to have a recession, and the recession is going to be what gets us into stagflation. It seems to me that the recession that they're anticipating is what you're seeing in your slides here. The reason is, Harley Bassman said, that the Eurodollar curve doesn't make predictions. It just shows what's being discounted in. It sounds like what's being discounted in is a recession is coming, and that certainly is consistent with my view. My thought has been, though, that this recession, although obviously there has to be some contraction of economic activity, that's exactly what a recession is, that there would still be an overlying or underlying trend towards secular inflation, and that would get us into stagflation. I don't see what you're saying here as really countering that. You're just saying the recession's coming. Well, we've been saying that on MacroVoices for months now. What am I missing?
Because it's not just a recession, it's a deflationary recession. That's really what the Eurodollar futures curve is saying. Because again, ask yourself, what is it that's going to get Jay Powell this year out of his rate hikes? It's not any garden variety recession, because he said, I don't care about unemployment anymore. In fact, I'm preparing for the unemployment rate to go up a little bit. And the market is saying, yeah, we know that. So what is it that's going to take Jay Powell out of rate hikes? And the answer is a CPI that's no longer a problem. So if consumer prices are going to come down this year, that would allow Jay Powell to back off his single mandate and go back into his more comfortable dual mandate, where he's going to pay attention to what was likely to be, certainly according to these curves, not just a dot-com mild recession that just backs off the economy a little bit for a short period of time. There's something a little bit bigger going on here. And that's really what these markets are saying. It's not just the Eurodollar futures market. It's not just the Treasury curve. Again, the spike in the U.S. dollar exchange value is global bellwether for financial conditions, especially in the U.S. dollar denomination, global Eurodollar system. It's not just a recession. There's more to it. And we'll get to some of the biggest dangers at the rest of the presentation here. The real deflationary dangers of money happen to be collateral. So yes, we do have what appears to be global recession. I think a lot of people have come to terms with that. There's some places where they're still in denial. Certainly central bankers are in denial. Politicians are in denial. I don't think the public is in denial, because I think most people in the public can see that what's coming too. But the markets are pretty resolute in saying that this is not stagflation. It's another deflationary recession that's going to back off consumer prices. And again, that begs the question, what kind of a recession will do that? What kind of a recession breaks the back of consumer prices that have been the highest they've been in 40 years? What kind of recession takes Jay Powell out of his I'm only going to care about CPIs and make him not care about CPIs anymore? That's really the message here.
Jeff, as we're speaking on Tuesday afternoon, we've got commodities really crashing. Crude oil down $10 since the overnight session. We've got copper down. We've got gold down. Everything is down. Is that part of what we're depicting here essentially on pages 14, 15, 16, this just trend of deflation coming into the equation for the first time in several months, or is this about something different?
Yeah, Eric, I think that's really what we're talking about here, is that the markets are starting to get the sense, number one, that the commodities in particular have been very favorable. They have a very, very, very favorable supply side picture for a very long time. And I don't think that's really changed. Some commodities that has, some supplies have come back up again, so they've started to rebound. But this is really about demand as well as monetary risk. It's about deflation risk, especially we see copper crashing as much as it has. Gold in particular, which is another deflationary signal, especially when it goes down in some of the sell-offs that we've seen, as well as, oil prices, although, oil is still relatively very high, but to fall as much as it has today, it's really all, again, crypto prices, things like that. These are all deflationary signals that the market is starting, these varied markets are starting to prepare for, which is not just your usual recession. There's a little bit more to it there. There's a little bit more emphasis there. And when you look at, and I probably didn't do a good enough job describing the Eurodollar curve or the yield curve, and just how much it has changed over the last several weeks and the last several days. It's not just your usual, hey, we're kind of worried about a recession. It's, hey, we're worried this is going to be a quote unquote recession, which is more likely deflationary than not. And I think that's why the curves have changed as much as they have. And as I was saying in slide 16, and of course, slide 17 too, we talk about it's not just a U.S. phenomenon, because this is a Eurodollar global monetary issue. It's a global economy phenomenon. And you're starting to already see, if you go to slide 18, some of the deflationary trends develop in macroeconomic sense as well. One of those has been container prices. container prices had been one of the primary ways or primary signals of the quote unquote inflationary possibilities of 2021 and forward. Container prices on the China East Asia to U.S. West Coast route, for example, got up to around more than 20,000, then peaking last October, again, another October signal. And they have simply crashed over the last several months. As of the last reading here, according to the Baltic Index from Freightos, that the container price on that route was less than $7,500 or around $7,500, which is less than it was last year. Even though China is just now reopening, Shanghai and some of the ports along the East Coast are just now coming online, and all the freight companies were expecting a bounce in container prices as well as a surge in activity as China is reopening, and it didn't happen. So it's not just demand and recession risk in the U.S., it's demand and recession risk across the entire world, including China as it reopens, and it's one market after another. You're starting to see, of course, we have an inventory problem in the United States as well as other parts around the world, partially related to the container prices and the difficulties that they represented in shipping goods around the world. And what happens when companies, especially retailers and wholesalers, start liquidating inventories? Prices are going to fall sharply, and they're already starting to be discounted in a lot of different places. So it's not, again, to your point, Erik, it's not just a recession that hits at the same time as inflation. It's a deflationary recession that hits at the worst possible time, which is why these curves are changing so quickly and so it's signaling what they're signaling, despite the fact that Jay Powell and the mainstream narrative is completely lasered focused on CPIs and inflation going forward, when all the signs and ingredients, especially today, markets are becoming more and more increasingly confident, if not certain, that the opposite is going on. And if you get into slide 19, we go to slide 19, we get to the real deflationary stuff. The biggest risk, in my opinion, which is always the biggest risk when it comes to money. And it's the one thing you never hear anybody talk about. Certainly nobody ever at the Fed. And in a single word, it's collateral. Collateral shortage, collateral scarcity. It has been the bane of our existence since August of 2007. 2008 crisis, as you and I talked about many times, Erik, was never really about subprime mortgages. It was about how subprime mortgage bonds had become priced and used the same as good quality collateral, when that was never really the case. Just going over slide 20 and slide 21, why that's a problem, what it actually means, some of the ways in which collateral is used. It's used as its own form of currency, so it is every bit monetary-like as cash is. In particular, in 2022, we have the same problem largely as in 2018, 2019, where you have a lot of crap collateral from junk corporate bonds, Euro bonds around the world, things like that have found their way into the collateral streams and collateral system. And now that the economy is facing the prospects of less than red hot recovery and now maybe global recession, you have this collateral squeeze that's every bit familiar for anybody who's been paying attention over the last couple of years, except that in 2022, some of these collateral shortage indications have gotten to their own extremes, which represents serious deflationary danger. Slide 22, for example, we see in Treasury bill yields just absolutely incredible premiums being paid in primary and secondary markets for especially the 4-week instrument, where the 4-week Treasury bill yield that's so much less than the RRP or IOER represents a huge liquidity premium that the market is paying, or the system actually, the monetary system is paying just to acquire the best quality collateral. And at times it infects the 8-week as well as the 3-month bills too, especially early in the morning when illiquid trading, Asian trading, where the previous day's repo and interest rate derivatives and other derivatives are being unwound, collateral calls being made. What you see is there's a massive, massive squeeze for the best quality collateral, which tells us that the system is incredibly fragile. It is incredibly short of collateral, and that leads to all sorts of other risks. And we see that not just in the T-bill market. If you go to slide 23, repo fails, another indication of a collateral shortfall. Just recently, in the first week of April, repo fails got as high as they had been in the worst week of the March 2020 panic. I'll say that again. Repo fails in April of 2022 were the worst that they had been since the worst week of March 2020. And then that happened again just recently. The last data we have from the Federal Reserve Bank of New York primary dealer statistics for the week of June 22, almost $500 billion in repo fails during that week, which would have put it as, the second worst week in March of 2020. So there are extreme indications of extreme collateral shortages, which is itself a monetary deflation signal. And you can see it again going forward to slide 24. Collateral fails against something like JPY, the Japanese yen, because Japanese banks are a key redistribution point in the Eurodollar system. They're highly exposed to collateral because most of what they're doing is collateralized by U.S. Treasuries and their ability to secure U.S. Treasuries. And so there's a very direct and easy to see relationship between something like repo fails, therefore collateral shortage, and the absolutely ridiculous tumble in the Japanese yen. And look at where it really starts. Again, October. Just like the Eurodollar futures curve began to flatten and invert, just like the U.S. Treasury curve began to flatten and now inverts. The Japanese yen and repo fails. Those start to they start to elevate. And Japanese yen starts to fall last October. Consistent deflationary probabilities and signals throughout. And as I mentioned before, another big one that checks off both collateral as well as the rising dollar, therefore the global bellwether of financial conditions, slide 25. We have the Federal Reserve custody of U.S. Treasuries owned by basically foreign central banks. Those tend to disappear when we have collateral problems in the global system. And sure enough, going back to last year, U.S. Treasuries disappear from custody at FRBNY because foreign central banks are using them for some reason. And again, we don't have to really guess what that reason is. It's likely to be because they're facing, or banks in their jurisdiction are facing collateral problems as well as Eurodollar problems, and therefore they have to sell these U.S. Treasuries. At the same time, of course, the U.S. dollar spikes in exchange value. Now, what is it today? I think it's almost 107 on the DXY, which is a very deflationary signal. The dollar, especially when it goes up at a very high accelerated pace, is a very dependable sign of deflationary money working its way through the global monetary system. So just finishing back up with slide 26, going back to Eurodollar futures curve, again, we have to ask ourselves, what would it take to get Jay Powell out of his I'm going to fight inflation till the day I die and do it this year? Because that's the probability that's being priced into the Eurodollar futures curve. And today it's being priced even more with more certainty, much higher probability and confidence. And again, it's not just by regular retail hedgers, but by those that are running trillions upon trillions of fixed income risk portfolios around the world. The monetary system itself is telling us what the risks are. And the risks are not inflation. The risks are, in fact, rising probability, rising potential for not just recession, but also deflationary recession.
Okay, Jeff, so you're calling for deflationary recession. A lot of other people are calling for recession, but they're expecting that recession just to pause the inflation, and that the inflation would return and develop into stagflation. It seems to me, Jeff, that the question really is, well, wait a minute. If the market is just pricing in, Powell thinks he's going to continue with these hikes. We all know that the market is going to take a nosedive, and that probably the Fed is going to be forced out of that policy position because they've got to do something in order to try to rescue falling markets. And the question then is whether they'll be able to do anything to rescue falling markets, or if that would just set up a stagflationary fail. So I see what you're saying with all of the slides, and I see where they're going. But Jeff, wouldn't these slides also explain the scenario where the market is just discounting that there has to be a recession and that the Fed is going to be forced out of its tightening cycle because of the recession?
Yeah, well, I mean, that's part of the equation here, but it's also the long run potential or the long run problems that we're still facing here, which is that inflation is a monetary phenomenon and there has been no money printing. Yes, the Fed has created bank reserves, and the Fed doesn't actually tighten or loosen monetary policy. The banking system does. And so the banking system, by virtue of these curves, is telling us that we don't see any inflation down the road. We don't see any inflation, of course, during the recession. the recession gets to be bad enough, the deflationary monetary conditions get to be bad enough to change Powell's policy. But this isn't just about the Fed. This isn't just about rate hikes, nor is it about balance sheet runoff or quantitative tightening. The collateral system, for example, which is well outside the Federal Reserve's ability to handle, markets are saying that the recession that we're likely in right now, if we're not in it right now, that we shortly will be in, is not going to be just a pause in the what everybody seems to think is a secular inflationary trend. It's going to represent the reversion to the same mean that we were in throughout the decade of the 2010s. In other words, what changed in 2021 wasn't money, it wasn't policy, it wasn't currency, it wasn't inflation. And therefore, the recession represents the way in which we go back to the same deflationary, disinflationary position that we had been in before 2020 COVID pandemic. And it's not just one market or another. It's all the markets together that are talking, that are pricing and hedging against not just this year, but future years. It's about long run potential. The yield curve, for example, long end of the yield curve is all about growth and inflation potential, not just today, but over the long run period, or at least as much as we can identify and forecast. The flattening and inverted yield curve isn't just about recession in 2022. It's also about what comes after it. So it's not just about the Fed. In fact, it's not really about the Fed at all. It's about the fact that what changed in 2021 was a short run imposition of consumer prices, and that those are likely done with. And now we're stuck with an economy that is worse off, a financial system that is worse off, a monetary system that is even more fragile than it was when we started this whole thing. And that represents a very different long-run scenario than secular inflation.
Jeff, last time I had you on the show, we talked about increasing prices that were not inflation. In other words, that there were causes for prices to increase that were not monetary inflation. Now, as you make your arguments in this slide deck, it seems to me like, okay, you've made a very compelling argument for why inflation perhaps is ending. We're not going to see more inflation. The inflation's going to come out of the system. I would make the argument, though, that from everything I can see in crude oil supply and demand fundamentals, in the case of crude oil, at least, I think the price is set to rise further. And it's not because I don't believe in the recession. I think the recession is coming. I think that has to pull a lot of the wind out of the sails of crude oil, so to speak. So this huge sell-off that we've seen of more than $25 from the peak to and $10 in the last 10 hours almost, as we're speaking on Tuesday. Sure, that is probably the market discounting the oncoming recession. But if I look at what, say, Citibank's estimate of how low oil prices could go in a recession, they're saying maybe $65. On the other hand, if I look at JP Morgan's estimate of how high oil prices could go, if Putin decides to intentionally game the West by withholding access to Russian oil and gas at the worst possible times, then they think it could go to 380. I'm guessing the real answer is in between somewhere, but I'm leaning toward oil prices continuing to move higher, regardless of inflation or deflation, just because I think there are some ingredients in that market that could be gamed by Vladimir Putin to Russia's advantage in this war. And I think it's going to take oil prices much higher, not because of inflation. But wait a minute. Oil prices are really one of the biggest inputs to the cost of everything. So does that have the potential to set up a feedback loop that eventually does bring us to inflation or stagflation? Or do you think that I'm wrong to expect oil prices to still be strong, independent of this big wave that we're seeing in downward pressure on all commodity prices?
Well, Erik, I would, you know better than I do about the oil market. And so there's no one better to ask about what's going on in terms of oil fundamentals. And if you think that the supply factors are going to be a long run problem, and I have no reason to doubt that, I think you're probably correct about that. But that doesn't necessarily mean it's inflationary. It could actually be deflationary, because that's exactly what we're seeing right now. If oil prices go to, hell, even $150 a barrel from here, even let's assume that they fall further, they settle at some eventual low because of the recession, lack of demand, or the short run. and then they start rising back up because the supply factors have never been fixed, and they aren't going to be fixed in any kind of reasonable foreseeable future. So we get into a recovery scenario. Oil prices go right back up to $100 a barrel, 150, whatever. That's not necessarily inflationary either, because it could, and in fact, the market is pricing that it's likely to become a drag or imposition upon growth in other sectors. If you have to pay a lot for oil prices, absent money printing, absent credit growth, then what's going to happen is that's going to rob from other sectors of the economy. It's redistribution in the most inefficient, deflationary way. So if oil prices go up for structural factors, I would say that's even more deflationary, because it's going to harm the global economy down the road. It increased costs that it can't be passed along to consumers, especially consumers and businesses that are already struggling. It's just going to create even bigger problems for them, which means they're going to hire fewer workers, which is going to mean they're going to pay less for their workers because they can't afford to. You don't ever get into that feedback loop because it's not inflationary. So the higher oil prices go for structural reasons, the more likely, in my mind, again, going back to these curves, going back to the U.S. dollar exchange value, all of these highly pessimistic long-run scenarios, it may be that the market is thinking exactly like you are, Erik, and saying, what happens if oil goes up to 150 in the recovery period? What happens if oil gets to 200? It doesn't become inflationary. It becomes even worse growth prospects than we faced in the 2010s. And that's just a frightening long-run scenario to me. That's even worse than inflation.
I want to talk about another aspect of this hypothesis that you're setting forward, because it seems to me this could be the first time in many decades that we had what I'll call a coordinated global recession, in the sense that normally economies around the world are on slightly different time cycles. But we just had everybody in unison go through the COVID pandemic. So you get to a major natural event, which should have been a real negative on the economy, but central banks around the world stimulated like there was no tomorrow, and that allowed the immediate time frame around the actual pandemic not to be recessionary. Now it seems like, because of the advent of inflation, central bankers around the world have to take their foot off the gas, and it's setting up a perfectly time-synchronized global recession. Is that a concern? And if so, have we ever seen anything like that in our lifetimes? Because we haven't had something like a pandemic to coordinate all the time clocks around the world for every economy to set this up before.
Sure. I would disagree a little bit, Erik, because I think we've seen coordinated, globally synchronized economies for the last 15 years. I mean, that's what 2008, 2009 was. The Eurodollar system set globally coordinated recession in 2009, in particular, across the entire world, including emerging markets. And then it happened again in 2011, 2012, and it happened again in 2015, 16, and then again. They even called it globally synchronized growth in 2017. They just forgot to rename it as globally synchronized recession by 2019. But again, it's synchronized. But to your larger point, I think that's the problem, is that there is no way, because all of these clocks have become synchronized, and the COVID pandemic, and I agree with you there, the COVID pandemic only synchronized things even further. That just means that when we do go into a downturn, or we do get into these deflationary pressures, there's no outlet valve. There's no China, for example. The U.S. goes into recession, but China's really booming to cushion the blow. If the U.S. goes into recession, China goes into a hard landing at the same time. That's bad news for everybody. And again, I go back to what markets are pricing currently, these curves. That's kind of what they're saying, is that in this globally synchronized world, this globally synchronized economy, especially as it's linked together by the monetary system, Eurodollar system, not central banks, by the global monetary system, that increases the potential for real havoc, disorder, financial disorder. I mean, we're seeing it today as we speak. We're actually seeing that the downside consequences of all of these things playing out at the same time and in the same way, because there is no individual economies. There is only the global system. I think that's a mistake that mainstream economics really badly needs to correct, because in the public's mind in particular, that individual economies are treated as individual economies when they really aren't. And there are all sorts of feedback mechanisms that make these things pro-cyclical. So once we do get into the downturns, that's why, for example, the 2001 recession or the 1991 recession. Those were relatively mild because it was only the U.S. or basically the U.S. experiencing mild, moderate recessions that were not stitched together by the Eurodollar system malfunctioning. So as we go into downturns and recession potential in 2022, there is no source of strength to really stop it. Central bankers aren't going to stop it. Governments aren't going to stop it for various reasons, including, as you said, Erik, the fact that they're all convinced this is inflation. So the last thing they want to do is start to do quote unquote stimulus, which doesn't really stimulate. But the last thing they're going to do is try to stimulate an economy when they've said we can't stimulate the economy. So again, the downside potential builds not just in markets, but in actual fact across the real economy.
Well, Jeff, I can't thank you enough for another terrific interview. But before I let you go, there's been some changes in your life. You're with a new shop, Atlas Financial Advisors. Who is Atlas Financial? What's the nature of that relationship? And particularly, tell us more about what's going on with Eurodollar University, the ongoing podcast that you and our friend Emil Kalinowski have developed.
Yeah, the podcast with me and Emil, that's not going to change. If anything, we're going to add more to it because I now have a little bit more free time to focus on some of the things we want to accomplish with Eurodollar University, some more academic focused work to try to get people to be aware of the monetary system and things like that. But I changed from Alhambra to Atlas Financial simply because it wasn't a good fit for me at Alhambra anymore. Some of the stuff that I talk about, some of the risks I see in the marketplace were kind of falling on deaf ears. And it made sense to go to a firm where I could have much better input to where it would be received. At least, I don't expect people to believe everything I'm saying or disagree, but I do expect that at least we can agree on some of the more fundamental aspects of what we're trying to do here, which is to describe the risks that clients are facing, to describe the risks that the economy and markets are facing. And to be able to do that at Atlas Financial, it was an attractive opportunity. And people may not realize that Atlas Financial is the place where Steve Van Meter, the bond king, that's where he hangs his hat. So Steve and I are going to work more closely together on developing strategies and maintaining and monitoring the strategies he has, allowing me to have more input over the portfolio process and things like that.
Patrick Ceresna and I will be back as MacroVoices continues right after this. After being completely sold out of advertising space for the last couple of years, we finally have capacity to add a new advertiser. MacroVoices has a PodTrack certified global audience of over 170,000 listeners, and each weekly episode typically gets 60,000 to 80,000 downloads. We have more than 20,000 accredited investors who have registered with us as accredited, and we estimate the total accredited investor audience as at least 40,000 accredited listeners, which we believe to be the highest number of accredited investor listeners of any podcast on the internet. We strive to accept tasteful advertising from advertisers whose product is likely to appeal to our audience. So we're looking for another investment or financial services advertiser to fill the space I'm speaking in right now. Mail order Viagra salesmen need not apply. If your company wants to advertise on MacroVoices, please email sponsorship@macrovoices.com for more information. Now let's get right back to the show.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Well, Erik, it was great to get Jeff back on the show. The one interesting thing that he at least made me think about is this idea that, really one of the drivers in my mind of the inflation shock obviously was a supply driven with commodities running. But if commodities have more or less stalled out and we're moving toward a recession, at minimum we'll end up seeing some sort of disinflationary pressures alleviate at least the current trends. And I wonder what implications it has on some of the different asset prices. Anyway, what did you take away from the interview?
Well, Patrick, the last time that we had Jeff on before this interview, one of the points that he made very strongly is he said, look, prices are increasing, it's because of supply chains and COVID and so forth. But it's important to understand that it's tempting to call that inflation. But if you really get to a technical definition of monetary inflation, which is about the growth of the money supply and too much money in circulation chasing not enough goods and services, Jeff was saying that's really not the phenomenon in play. And he did expect that the effects would be transitory for those reasons. Now, what it really brought me around to this time as I processed this interview and thought about it after the fact is I thought, well, wait a minute. If I really think through my view, I've been saying I'm convinced secular inflation is here. Well, hang on. I'm not really sure of that at all. What I'm pretty darn confident of is I see fundamentals in the crude oil market that I'm convinced there's going to be a supply constraint led very significant rally in crude oil prices. I think it's still to come, and I don't think it's going to be good for the economy at all. I also think that we're going to have a serious problem with food prices around the world, and it's going to cause really serious problems. Now, food and energy are input costs to just about everything else, and that could trigger a huge wage price spiral. So for all of these reasons, I've been telling myself, okay, these are all the ingredients for a real shift into secular monetary inflation. And this interview made me stop and think about, well, wait a minute. I really do see good, strong reason to expect food and energy prices to go through the roof, but it doesn't necessarily mean that monetary inflation is what's causing it. In fact, I can see in both cases that the drivers of those big price increases that I see on the horizon are not monetary inflation. It's because of what's going on with supply in the crude oil market, and it's because of the effects of the Russia-Ukraine war on the potash market and fertilizer prices. So it may be that there really is no monetary inflation, but I still think that prices are going dramatically higher and there's going to be a feedback loop. So at what point, if that feedback loop kicks in, does it actually beget monetary inflation? I think that's really the big question. But Jeff does make the good point that there's really no evidence, the facts and evidence do not support the conclusion that this is monetary inflation that's driving these price increases. But I still think that the price increases are set to continue and continue very substantially higher from here. So it'll be really interesting to see how this plays out. Let's move on, though, to the post-game chart deck, which is titled Summer Doldrums. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click on the red button that says Looking for the Downloads. Patrick, Summer Doldrums, stock market anyway. If you're thinking that, you weren't trading commodities this week.
Oh, you know what? When you said that at the market wrap, I was like, yeah, maybe I should have thought about the title a little bit more because I really was thinking about the stock markets when I was coming up with the title. But you're bang on because when we look at the rest of the charts on here, we can see substantial volatility in so many of them. But what was really interesting is that what we have is in the stock markets, really the downside momentum has stalled. And there's no shortage of people coming out contemplating the idea that maybe a stock market bottom can form. And the interesting thought to me is like it is not out of the realm of impossibility for a market bottom to form, but we really lacked there being really one kind of capitulating event. And that doesn't mean a market bottom always needs one of those events. But the thing is that you also don't have a macro backdrop that is really supportive of sustained buying. And so to me, with both of those lacking, I still want to continue to, in the back of my mind, respect the primary trend, which has been the downtrend in play. What's interesting is that while we have rallied a little bit higher on the stock market, we haven't beat that little June swing high. But when we also haven't beaten fib zones, we haven't beat a 50-day moving average, we haven't beat the descending trend line. There really is no technical evidence that the bulls have put anything together. So it's an early speculation that bulls are betting on if they're calling the turn already. Now, the thought, though, in my mind is that what could really the market do that just creates the most amount of confusion and frustration in both bulls and bears. And in my mind, that would be the multiple fakeouts. So with this break to a lower low in June, if the market here temporarily worked its way north of 4,000 as the month of June just as a grind, and then offer some further volatility in both directions in August, by the end of it all, everyone's going to be so confused as to what's next in the markets that there will be a lack of conviction in almost everyone. I really am thinking, is that a real possibility? Now, before I get too neutral in that stance, we are approaching a very critical level here on the S&P. And if the bulls fail to legitimately clear 4,000 with any gusto, then I'm going to still stick by that the prevailing downtrend is the dominant trend that has to be respected here. What's your thinking?
Patrick, as I mentioned in the market wrap, the way that you know when a market has bottomed is when there is clear, decisive, bad news that comes out, new information that's bad, and the market doesn't go down on it. That means the market has just been exhausted. It's got no further down to go. There's no sellers left to sell, and it's all uphill from there. In some ways, this is kind of looking like that, but it comes at a time when I absolutely was not expecting it. I thought we were about to get an acceleration to the downside. Now, as far as what would really confound everybody from here, I think it would be if the market moved above the 50-day moving average, giving everybody a signal that, okay, the bottom really is in, and then we get the big dump from there. You could make the argument that we're seeing a bottoming process here, but boy, I sure wasn't expecting it. I thought we had much lower to go. What do you think?
Well, Erik, I just want to kind of think about it from one perspective. Like when we think back to David Rosenberg or many of our other guests like him that have often said that the Fed doesn't pivot until they break something. And the thing is clearly, as Jeff was telling us during the presentation, that there's all these indications that the Fed is going to, at some stage, stop rate hikes as we approach the tail end of the year. Exactly how it plays out is still to be determined. But I'm trying to imagine: does the Fed pivot without breaking something? And can the stock market be stable and rallying, and Powell just comes out and says, no, that's enough, and we're just going to stop raising rates here? And, when I put it in that perspective, I still find it very hard to want to kind of flip to any bull narratives. What do you think of that?
Patrick, I can't even think bull case because I was convinced that the market had much lower to go. But the thing I cannot explain here is the resiliency that we've seen in the market this week, in the stock market. And I don't have an explanation for that. What we know is that when you get bad news, the market's supposed to go down more. When the market doesn't go down on bad news, that's usually a sign that the bottom is finally in. Now, as an example of bad news, let's move on to page 3. We've been watching the Eurodollar cross, and you've been warning our listeners for weeks and weeks now that if it breaks below that support level, that there would probably be a sudden and abrupt acceleration to the downside. That's exactly what's happened in the last 3 days. You'd expect that signal to kind of tell the stock market, boy, dollar breaking higher, euro breaking lower, taking out critical support. Bad news, bad news, bad news. But going back to page 2, stock market's actually kind of up on the last 3 days. I cannot explain that. Can you?
Well, the stock market is sort of marching to the beat of its own drum temporarily. Inevitably, intermarkets do trickle their way through, and, investors don't care until everyone cares, and then they all care at once. And so you never know when the stock market will have some sort of reaction. But to the point, though, on the euro, it was a very important support line that we were testing through May and June. And this breakdown is some serious technical damage, which really really puts us within a stone throw of that parity level. And I think that this is the bigger intermarket story when it comes to the commodities and things that we're seeing, whether it's gold or any of these other assets. Like, it's no coincidence that the euro breakdown corresponded with that big breakdown day in gold. And I think that the next real big moves in the US dollar are actually going to be critical for that bigger story, because generally a rising dollar has disinflationary or deflationary pressures that trickle through the whole system. And I think the biggest macro call to make is, when does this dollar move end? And I don't know whether I have a strong conviction to make that call, but the trend is very dominant right now, and there's no reason to immediately believe it's over. There is certainly on the short term, at least on the Euro US, slightly oversold, but certainly nothing that comes jumping off the sheets that it needs to end tomorrow. And this I think is the chart to watch, because at some point, if the US dollar just keeps going, the stock market has to start to care at some point. Though, Erik, I want to move on to crude oil. And what a breakdown day we had earlier in the week. Just one heavy sell day that really, I mean, we haven't seen a big drop like that since March, when there was the reactions off of the Ukraine pop. And the selling was substantial. But I, in my mind, have really been watching more or less the 100 level as a nice clean round number as sort of the arbiter of the trend. And to me, the real sustained selling happens if the bulls can't keep the price above 100. The fact that we rebounded it back above 100, in the back of my mind, still keeps the window slightly open that the bulls will be able to put something together here. We came to a pretty big high volume node consolidation zone from all the trading that happened in April and May. It'll be really interesting to see whether that sell-off the other day will be just in the end brushed off and the bulls make it all the way back to 110 in the coming days. One way or another, the one thing I will say, the bulls, in my mind, need to erase that sell-off from earlier in the week very quickly to really solidify that the bulls are still in control. And so I'll be watching to see whether they can make it back to 108, 109. What are your levels?
Well, Patrick, if I look at this chart, it just says to me, boy, oil has entered a bear market. It's probably got a lot much lower to go. Sell the next bounce and get the hell out. But if I look at the time spread charts, they give me the exact opposite. We've gone substantially higher since the 14th of June, which is where the peak is on this chart, on time spreads, not lower. And that's because the physical market is getting tighter and tighter and tighter. So I'm convinced that the big sell-off we see here since the 14th of June on this chart is the market pricing in a recession. And I don't think the recession is actually going to bring the price of oil down. I think it's going to go higher during the recession, and I think the fact that it's going higher is going to exacerbate the recession and make it worse. But for now, everybody's on the old school logic is, hey, if there's a recession coming, surely that must mean it's got to be bearish for crude oil, so let's sell crude oil, and that's what they're doing. Let's move on to page 5 with gold futures. We're coming back down to that critical zone that we had on the chart from, a year ago.
Yeah, you were talking about that, the 1680 zone in the market wrap. And I mean, those lows from 2021 all were from those kind of key levels. And it's all within a stone's throw. And this is the interesting part. So the gold really has been acting as a cross currency to the US dollar. And when you look at the trends in the euro and pound or any other cross currency, you can really get a sense of the pressures that have been under, that gold's been under. And so as we approach these support lines, it'll be really interesting to see whether or not this becomes where all of the short-term lows on gold start to establish themselves. And more importantly, how fast do gold prices recover if they do bounce there? There's this chart right now there's no other way to put it, is incredibly ugly. And while I remain a bigger picture bull in gold, I can't say anything about this chart that is positive other than it's incredibly oversold and coming towards support lines. And for some traders, that's that's enough. But I think that this is going to be a grind into the summer for gold along these support lines. And maybe it's going to be waiting until the late third and most likely fourth quarter to really potentially see any meaningful turn higher. That's at least my starting base case when looking at this chart.
Let's move on to copper on page 6. Boy, that sure looks like a reversal candle yesterday, doesn't it?
Well, yeah, but it was a reversal candle after an absolutely devastating downtrend sequence. I mean, we went from $4.50 to $3.25 in a span of like 3 weeks. It was just an awful decline in copper, one that copper hasn't seen in an incredibly long time. We're finally getting a short-term bounce, but after such a huge drop, this is a par for the course to see some reaction. We could even probably see 375 or 4 on a reaction, but this is now a very distinct downtrend, and it'll be really interesting to see what kind of follow through the bulls will be able to put together during this bounce, and whether it just stays very shallow and methodically sold, or whether the bulls actually legitimately put some money behind it and create a bounce. It's certainly a chart to watch into next week.
Let's take a look at 10-year bond futures. We look at the yield all the time. We're looking at the price this time. What is this chart telling us?
Well, Erik, I just wanted to put the 10-year bond future on to give us the inverse look of what we typically are looking at on the yields. And one of the interesting things that we're seeing is the potential turn in bonds. And one of the things that gives me that environment, that feeling, is that when you have a strong dollar and commodities coming off, it certainly could become some of the catalyst behind some disinflationary pressures. And if the market's starting to sniff that we've seen peak inflation, maybe the bond selling ends. One of the big things I'm going to be watching for is that during this little dip, whether bonds make a lower low, or if they turn around and make a right shoulder of an inverted hen shoulders or double bottom formation, then maybe I'll start to increase my conviction that maybe the worst is behind bonds, at least for the intermediate period. And that'll be interesting to see whether that develops into a trade.
It sure will be, Patrick. And listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading, Patrick's trading service. You can get the information on pages 8 and 9 of the slide deck, or just go to bigpicturetrading.com. We're going to leave it there for this week's show. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what's in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview, as well as a link to Jeffrey's slide deck, as well as the chart book we just discussed in the postgame, as well as a link to a number of articles that we found really interesting. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get for our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow me on Twitter at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.